something shifted. Not overnight, not in a single announcement or headline, but slowly, then suddenly, the way most profound market changes actually occur. Silver has crossed $100 per ounce. If you're watching this video, you already know that price alone isn't the story. The story is what that price represents, what forces had to align, what assumptions had to break, and what typically follows when an asset that spent decades in quiet consolidation finally breaks free. This isn't about celebration or panic, it's about understanding what comes next. Because history doesn't repeat, but it does rhyme. And right now, we're hearing echoes of patterns that anyone who studies market cycles should recognize. Whether you hold silver or not, whether you believe in precious metals or dismiss them entirely, this moment tells us something important about the broader financial system. Today, we're going to walk through this shift with clarity and restraint. No hype, no fear-mongering. Just the kind of honest analysis you'd expect from someone who's been watching these markets long enough to know that the most important moves are rarely the ones that feel comfortable. If you already own silver, you're probably asking what this means for your position. If you don't, you're wondering if it's too late or if this is just another bubble waiting to collapse. Both questions deserve thoughtful answers. So let's begin with what actually changed and why most people are looking at this entirely wrong. For over 40 years, silver traded in a range that felt permanent. There were spikes, certainly. 1980, 2011, brief moments of attention before settling back into obscurity. The financial establishment treated silver as an industrial commodity with some quaint monetary history. Central banks focused on gold. Institutions allocated capital to equities and bonds. The average investor, if they thought about silver at all, saw it as something your grandfather kept in a safe. That dismissal was never about silver's fundamentals. It was about a system that had convinced itself that paper assets, managed by central authorities, could indefinitely replace harder forms of wealth. Now silver has crossed a psychological threshold that changes the conversation. $100 isn't magic, but it's memorable. It's a number that forces attention. More importantly, it's a number that reflects underlying pressures that have been building for years while most investors looked elsewhere. The change isn't just price, it's context. We're living through the consequences of decisions made over decades. Monetary expansion that was supposed to be temporary became permanent. Debt levels that were supposed to stabilize kept climbing. Interest rates that were supposed to normalize stayed suppressed, then briefly spiked, creating instability across every asset class. And through all of this, physical assets with no counterparty risk, no earnings reports, and no management teams to trust quietly absorbed that pressure. Silver isn't breaking out because of sudden industrial demand, though that matters. It's breaking out because the alternatives are showing cracks. Let's talk about what you're not hearing in mainstream financial media. The confidence crisis isn't coming. It's here. Not in the form of panic or collapse, not yet, but in the quiet recalibration happening across global markets. Investors who spent their entire careers trusting that central banks could manage any crisis are starting to question that assumption. You see it in the sovereign debt markets, where yields tell a story of concern masked by intervention. You see it in currency volatility that shouldn't exist if the monetary system were truly stable. You see it in the growing disconnect between asset prices and underlying economic reality. Silver breaking $100 is a symptom of this larger shift. Because silver, like gold, like any tangible asset with a history stretching back millennia, offers something paper assets cannot provide during a crisis of confidence: independence from the system itself. When you hold silver, you're not trusting a government's promise. You're not depending on a corporation's profitability. You're not exposed to counterparty risk if a financial institution fails. This matters tremendously when trust begins to erode. And make no mistake, trust is eroding. Not in a way that makes for dramatic headlines, but in the steady accumulation of doubts among people who manage serious wealth. They're not abandoning the system entirely, they're hedging. That hedging creates demand. Demand at scale creates price pressure. And price pressure, when it crosses memorable thresholds, creates a tension that brings more demand. This is how cycles accelerate. Let's ground this in fundamentals, because price movements without context are just noise. The global economy is navigating something unprecedented. We've taken on debt levels that dwarf anything in peacetime history. Not just government debt, though that's staggering, but corporate debt, household debt, and the implicit obligations built into pension systems and social programs. This debt was manageable when interest rates stayed near zero. Servicing costs remained low. Governments could roll over obligations indefinitely. The music kept playing. But then inflation arrived. Not the transitory kind central banks promised, but the persistent kind that forces policy response. Interest rates rose, creating immediate problems. Governments now spend enormous portions of their budgets just servicing existing debt. Corporations that borrowed freely for years face refinancing at much higher costs. Commercial real estate, dependent on cheap leverage, entered distress. The central banks faced an impossible choice: continue raising rates and risk breaking something critical in the financial system, or pause and accept that inflation might remain elevated longer than anyone wanted. They chose the pause because the alternative was unthinkable. But pausing doesn't solve the underlying problem, it just postpones the reckoning. And sophisticated investors know this. They understand that when you can't raise rates enough to truly control inflation without triggering systemic crisis, the logical conclusion is that inflation stays higher for longer, and currencies lose purchasing power gradually rather than catastrophically. This is the environment where hard assets perform, not because people panic, but because they calculate probabilities and hedge accordingly. Here's where conventional thinking goes wrong. Most people view precious metals as investments that should generate returns like stocks or real estate. They want to see earnings growth, dividends, cash flow. When silver or gold just sits there doing nothing for years, they conclude it's a bad investment. This misses the entire point. Silver isn't primarily an investment. It's insurance against specific systemic risks. It's a store of value when other stores of value prove unstable. The question isn't whether silver will outperform the S&P 500 over the next decade. The question is, what happens to your wealth if the assumptions underlying conventional portfolios prove wrong? What if inflation doesn't return to 2%? What if government bonds, traditionally the safe haven, lose value both in nominal terms and purchasing power? What if the currency you're denominated in weakens significantly relative to tangible goods? These aren't fringe scenarios anymore. They're possibilities that serious wealth managers now factor into their models. Another misunderstanding. People assume that when silver breaks out, it's time to sell. They treat it like a momentum trade, where you ride the wave and exit before it crashes. But precious metals bull markets don't work like tech bubbles. They tend to grind higher over years, with violent corrections along the way, driven by fundamental forces that take time to play out. The investors who do well don't trade in and out. They hold through volatility because they understand the thesis hasn't changed, only the price has fluctuated. This requires a different mindset entirely. Let's look at what history actually teaches. In the 1970s, silver rose from under $2 to nearly $50 over the course of a decade. This wasn't random speculation. It was a response to specific conditions: high inflation, currency instability, declining trust in government economic management, and the aftermath of breaking the gold standard. The move higher wasn't steady. There were brutal corrections that shook out weak hands, but the overall trend was unmistakable, driven by forces larger than any individual trader or even institution. When it finally peaked in 1980, it collapsed spectacularly. But here's what's important. It collapsed because the underlying conditions changed. Paul Volcker raised interest rates to levels that crushed inflation regardless of the economic pain. The dollar strengthened dramatically. The reason to hold precious metals diminished because the alternative, dollar-denominated assets, became attractive again. The 2000s saw another cycle. Silver bottomed below $5 after the dot-com crash and rose to nearly $50 by 2011. Again, this wasn't random. It reflected zero interest rate policy, quantitative easing, sovereign debt concerns in Europe, and broad skepticism about paper currencies. When that cycle ended, it was because central banks appeared to have stabilized the system. Growth returned. Inflation stayed low. The crisis seemed managed. Each time silver and precious metals had a major run, it was because the system faced credible stress. Each time they topped and declined, it was because that stress was resolved or at least postponed. Now ask yourself, have the current stresses been resolved, or have they intensified? The debt is higher. The monetary base is larger. The geopolitical tensions are worse. The wealth inequality that breeds political instability is more extreme. If anything, the conditions that typically drive precious metals higher are more pronounced now than in previous cycles. That doesn't guarantee prices go up from here. It suggests the fundamental backdrop supports further strength over time with volatility along the way. Understanding price is important, but understanding psychology is essential. Markets move through phases that are remarkably consistent across asset classes and time periods. First comes accumulation, when smart money quietly builds positions while most people aren't paying attention. Then comes the early markup, where price starts rising but skepticism remains high. Everyone who missed the bottom has reasons why it can't continue. The headlines are still dismissive. This is approximately where we are now with silver. Next comes the acceleration phase, where momentum builds, media attention increases, and people who ignored the move suddenly become interested. This is where gains come quickly, but volatility increases dramatically. Finally comes euphoria, where everyone believes the trend will continue forever, valuations lose touch with any reasonable fundamental basis, and even conservative investors feel they're missing out. That final phase is where bear markets are born. Right now, silver at $100 has broken into mainstream awareness, but we're not seeing euphoria. We're seeing curiosity mixed with skepticism. Financial advisors aren't telling clients to sell everything and buy silver. Retail investors aren't maxing out credit cards to buy coins. This suggests room to run, but also that patience is required. The dangerous phase is when taxi drivers are giving silver tips, when everyone you know suddenly has an opinion about precious metals, when advertisements for silver flood your social media. We're not there yet. If you've held silver through the years of quiet consolidation, you've demonstrated the kind of patience and conviction that separates successful long-term investors from traders. The question now is what to do as attention increases and price volatility likely intensifies. First, recognize that this is what you were waiting for. You didn't hold silver because you loved watching it trade sideways. You held it because you understood a thesis that the market was ignoring, and you were willing to wait for that thesis to play out. That thesis is now getting validated. But validation doesn't mean the job is complete. The temptation will be to sell, take profits, feel smart about the gains. And there's nothing wrong with taking some profits if that helps you sleep better or rebalance your portfolio. But consider this. If the reasons you bought silver were correct, and those reasons haven't disappeared but have actually intensified, why would you exit the position entirely? The disciplined approach is to have a plan. Maybe you trim position size if it grows too large relative to your overall portfolio. Maybe you take profits on a portion and let the rest ride. Maybe you simply hold and periodically reassess whether the fundamental thesis remains intact. What you don't do is make emotional decisions based on short-term price movements. Silver could correct 30% next month and still be in a long-term bull market. If that would cause you panic, you're probably overexposed. The right position size is one that allows you to hold through volatility without losing sleep, because you're confident in the long-term rationale. Also, be aware that the media attention will increase. You'll see price targets thrown around. You'll hear predictions of silver going to 200, 300, even higher. Maybe those predictions prove right eventually. But attaching your psychology to specific price targets is dangerous. It creates disappointment if price doesn't reach those levels quickly, and it can cause you to hold too long if price overshoots and then corrects. Focus on the fundamentals, not the predictions. For those without exposure, the question is whether this is opportunity or trap. The honest answer, probably some of both, depending on your time horizon and risk tolerance. Buying an asset after it's broken out to new highs feels uncomfortable. It feels like you're chasing. Every instinct says you should have bought earlier, and now you've missed it. But that's emotional thinking, not analytical thinking. The analytical question is, do the fundamentals support further strength over the next several years, even accounting for volatility? If you believe that currency instability, inflation pressures, and debt concerns will remain features of the global economy, then an allocation to hard assets makes sense regardless of whether silver is at $100 or $80 or $120. The key is not trying to time a perfect entry. You won't catch the exact bottom. You won't time the corrections perfectly. What you can do is build a position gradually in a size that makes sense for your overall portfolio and with a long-term perspective. Dollar cost averaging into a position over several months reduces the risk of buying at a temporary top. It forces discipline and removes emotion from the process. But here's the crucial point. If you're considering silver now purely because of price momentum, because you see it on financial media and fear missing out, you're already thinking about this wrong. You should want exposure to silver, if at all, because you understand the monetary and economic case. Because you recognize that a portfolio entirely denominated in paper assets issued by governments running historic deficits carries specific risks that tangible assets hedge against. Price action might bring an asset to your attention, but it shouldn't be the reason you buy. If you don't understand why someone would hold silver, then don't buy it. If you can't articulate the thesis beyond it's going up, you're not investing, you're speculating. And speculation based on momentum alone usually ends poorly. Let's be practical about position sizing and risk management. Silver and precious metals more broadly should never represent the entirety of someone's wealth unless they're making a very specific, very high conviction bet that few professional managers would recommend. Most financial advisors who recommend precious metals at all suggest something between 5 and 15% of a portfolio, depending on individual risk tolerance and economic outlook. That range provides meaningful exposure if the thesis plays out, while limiting damage if you're wrong or if the timing proves terrible. At $100 per ounce, silver is expensive relative to its long-term average, but potentially cheap if we're entering an extended period of monetary instability. The point isn't to bet the farm, it's to hedge specific risks. Think about silver the way you think about insurance. You don't buy homeowners insurance hoping your house burns down so you can collect. You buy it accepting the cost as worthwhile protection against a scenario you hope never occurs, but recognize is possible. Silver works the same way in a portfolio. You accept that it might underperform in a stable, low-inflation, high-trust environment. But if that environment cracks, your silver position preserves wealth when other assets struggle. This framing helps maintain discipline. You're not trying to get rich from silver. You're trying to not get poor if the system experiences stress. That's a very different mindset, and it leads to better decision making. Now let's talk about the mistakes that destroy wealth during volatile markets. First, don't react emotionally to daily price movements. Silver will have 20% corrections during a bull market. If you panic and sell during those drops, you're guaranteeing you'll lose money. Volatility is the price you pay for the potential upside in assets like this. If you can't stomach volatility, you shouldn't own silver at all. Second, don't chase headlines or follow social media hype blindly. The internet is filled with people making wild predictions about silver reaching impossibly high prices within impossibly short timeframes. Some do this to generate engagement. Some genuinely believe it. Either way, treating these predictions as investment advice is dangerous. Do your own research. Understand the fundamentals. Make decisions based on your analysis and risk tolerance, not someone else's conviction. Third, don't overleverage. The temptation when an asset is moving in your favor is to amplify exposure through options, futures, or margin. This occasionally produces spectacular gains, but more often produces catastrophic losses. Leverage turns volatility into an enemy. A 30% correction in silver is survivable if you own it outright. The same correction destroys a leveraged position. If your conviction is strong, own the asset itself. Let time and fundamentals work in your favor rather than forcing the issue with borrowed money. Fourth, don't neglect the rest of your financial situation. Silver breaking out doesn't mean you should stop contributing to retirement accounts, ignore your emergency fund, or abandon diversification principles. A sound financial foundation always comes first. Precious metals are one component of that foundation, never a replacement for it. Fifth, don't assume this is a straight line higher. Bull markets have corrections that feel like bear markets. They shake your confidence. They make you question the thesis. This is normal. The investors who do well are the ones who expected volatility and planned for it emotionally and financially. Finally, don't try to become a trader if you're not a trader. Most people are terrible at timing markets. They sell near bottoms and buy near tops because emotion overrides logic. If you're a long-term investor, act like one. Make a plan, execute that plan, and revisit it periodically based on fundamentals, not price. Zoom out for a moment and consider what's really happening in the global economy. We're witnessing the late stages of a debt supercycle that began decades ago. Governments, corporations, and households took on debt, assuming growth would continue indefinitely. Interest rates would stay low, and inflation would remain dormant. Those assumptions are being tested. The Federal Reserve and other central banks face a painful reality. They can't normalize policy without triggering widespread defaults and financial instability. But they also can't keep policy loose without risking runaway inflation and currency debasement. They're threading a needle, trying to find a path that avoids both extremes. History suggests that needle is impossible to thread perfectly. Either inflation stays elevated, eroding purchasing power gradually, or they tighten too much and trigger recession or worse. Neither outcome is good for conventional financial assets. Bonds lose value in high inflation. Stocks struggle during recession. Cash loses purchasing power. This is the environment where alternative assets, particularly those with intrinsic value and no counterparty risk, become essential portfolio components. Silver is just one example. Gold, real estate in certain markets, commodities, even art and collectibles for those with expertise, all serve similar purposes. The common thread is tangibility and scarcity. You can't print more silver. You can't create it through monetary policy. Its value derives from physical reality, not consensus or confidence in institutions. When confidence in institutions wavers, that matters enormously. There's another dynamic at play that deserves attention. The global financial system has operated for decades under dollar hegemony. Most international trade is conducted in dollars. Most central banks hold dollars as reserves. This creates automatic demand for dollars and U.S. government debt. That system is showing cracks. Countries increasingly settle trade in their own currencies or alternatives. Central banks are diversifying reserves away from dollars, often into gold and other hard assets. The weaponization of the dollar through sanctions has accelerated this trend. This doesn't mean the dollar is collapsing tomorrow. It means the slow erosion of dollar dominance is underway, and that erosion has consequences. One consequence is increased interest in assets that aren't tied to any single currency or government. Silver fits this category perfectly. If de-dollarization continues, and there's little reason to think it won't given geopolitical tensions, demand for alternatives will remain strong. This is a long-term structural trend, not a short-term trade. Let's talk about what separates successful investors from everyone else during volatile periods. It's not intelligence, it's not access to information, it's not even timing. It's patience and discipline. The ability to have a thesis, execute on that thesis, and hold through periods where the market tells you you're wrong. Most people can't do this. They need constant validation. When an asset goes down, they assume they made a mistake and sell. When an asset goes up, they assume they're brilliant and often get overconfident. Both mindsets destroy wealth. The better approach is to separate your ego from your portfolio. Recognize that markets are volatile and often irrational in the short term. Your job isn't to predict every move. It's to position yourself appropriately based on long-term fundamentals and then have the discipline to stick with that positioning. This is harder than it sounds. It requires accepting that you'll look foolish sometimes, that you'll hold assets that underperform for stretches, that you'll miss other opportunities because your capital is committed elsewhere. But it also means you'll be positioned correctly when the shifts that matter actually occur. Silver holders who stuck with their positions through years of sideways trading looked stubborn, maybe even foolish, to people chasing tech stocks and growth assets. Today, that stubbornness looks prescient. The lesson isn't that silver is always the answer, it's that having conviction based on sound analysis and maintaining that conviction through difficult periods is how wealth is preserved and grown over time. Here's a perspective that might help frame all of this. Real wealth isn't measured in dollars or euros or any other currency. It's measured in purchasing power, in your ability to exchange your stored labor and capital for goods, services, and security over time. When you hold currency, you're trusting that its purchasing power will be stable. When you hold bonds, you're trusting that you'll be repaid with currency that hasn't lost significant value. When you hold stocks, you're trusting that the companies will grow profitably and that the currency those profits are denominated in remains relatively stable. These are layers of trust stacked on top of each other. And when that trust begins to fray, those layers become liabilities rather than assets. Silver represents a different approach. It's not perfect. It has no yield. It can be volatile. But it doesn't require trusting institutions or governments or corporations. Its value comes from its physical properties, its scarcity, and its history as a store of wealth across every civilization that's ever existed. In stable times, that's almost irrelevant. In unstable times, it becomes critical. We're transitioning from a period of unusual stability, at least in perception, to a period where that stability is increasingly questioned. Silver's rise reflects that transition. The title of this video says, "The crisis is here," and some might think that's hyperbole. It's not. But it's important to define what we mean by crisis. We're not talking about the financial system collapsing overnight, not about bank runs or currency hyperinflation or Mad Max scenarios. The crisis we're in is quieter. It's the slow realization that the assumptions underpinning the past several decades of finance and economics may not hold going forward. That's a crisis of confidence and framework, not immediately one of function. But make no mistake, this type of crisis has profound implications. It means asset prices across the board will likely remain volatile and disconnected from historical patterns. It means traditional portfolio allocation strategies might not work as they did before. It means investors need to think more creatively about preserving purchasing power. Silver breaking $100 is a symptom of this broader crisis. It's the market acknowledging that something fundamental has shifted. How this plays out over the next decade is uncertain, but the direction is becoming clearer. We're moving toward a world where hard assets matter more, where counterparty risk is taken more seriously, where currency stability can't be assumed. Positioned correctly, this isn't catastrophic. It's navigable, but it requires awareness and adaptation. So what should you actually do with all this information? If you already hold silver, review your position size. Make sure it still makes sense given the price appreciation. Consider whether taking some profits to rebalance is appropriate, but maintain core exposure as long as the fundamental thesis remains intact. If you don't hold silver but the analysis here resonates, consider starting a small position. Don't try to go all in at once. Build gradually, in a size that won't cause stress if price corrects before heading higher. Either way, educate yourself. Read about monetary history. Understand how central banks operate. Study previous commodity cycles. The more you understand the fundamentals, the less you'll be swayed by short-term noise. Also, recognize that silver is just one part of financial preparedness. Diversification across asset classes, geographic regions, and even currencies makes sense in uncertain times. No single asset protects against every scenario. Build an emergency fund in cash. Maintain income-producing assets. Hold real estate if appropriate. Keep some exposure to equities and quality companies. Silver complements these positions. It doesn't replace them. And stay humble. None of us know exactly how this unfolds. The best we can do is position for the most likely scenarios while remaining flexible enough to adapt if we're wrong. Silver crossing $100 is meaningful. Not because of the number itself, but because of what it represents about the state of our monetary system and global economy. We're living through a period of significant transition. The old playbook isn't working the way it used to. The assumptions about endless growth financed by endless debt are being challenged. This creates opportunity and risk in equal measure. For those who understand what's happening and position accordingly, the next several years could be financially rewarding. For those who ignore the signals or react emotionally, it could be painful. The difference comes down to education, discipline, and perspective. Silver isn't magic. It won't solve all financial problems. It won't make you rich overnight. But as part of a thoughtful, diversified approach to wealth preservation during uncertain times, it serves an important function. What comes next in silver specifically? Likely more volatility. Probably higher highs over time, but with corrections that shake out weak hands. Possibly a blow off top eventually, but not immediately. What comes next in the broader economy? Continued pressure on currencies, ongoing struggles with debt and deficits, persistent inflation above what central banks target, geopolitical tension that reinforces the flight to tangible assets. These are probabilities, not certainties. But probabilities matter. They're what we base long-term decisions on. The investors who thrive in the coming years will be the ones who accept uncertainty while still taking action, who position defensively without becoming paralyzed, who remain flexible without abandoning core principles. You don't need to predict the future perfectly. You need to be prepared for multiple futures and positioned to preserve wealth across different scenarios. That's what this moment demands. Silver at $100 is a signpost. It tells you where we are in the cycle. It tells you that hard assets are reasserting their role in portfolios. It tells you that the era of assuming everything works out smoothly is over. What you do with that information is up to you, but you can't say you weren't warned. The crisis isn't coming. It's here, not as explosion, but as erosion. And erosion, over time, changes the landscape completely. Stay informed, stay disciplined, stay prepared. Because understanding cycles and maintaining perspective matters far more than reacting to any single day's price movement. This is a marathon, not a sprint. And the ones who reach the finish line with their wealth intact will be the ones who recognize that early and planned accordingly. Thank you for watching.